And Mike, something we talk about often is dividend income funds. And we've had some murmurings about dividends in the budget. So there are going to be changes to dividends tax. So that's going to replace the secondary tax on companies. They're also doing away with structures and schemes that kind of try and evade tax for those going into dividends. How about dividend income funds themselves? How are they affected?
I think that if it's a genuine fund, which is what the Minister seems to be pointing to, is if there's an economic interest and it's a real dividend stream, that seems to be okay. As soon as you have one of three types of schemes involved where income is effectively swapped for a dividend stream using some fairly sophisticated mechanics, he's not happy. And I think the fiscus, looking for revenue lines in the current economic environment, was expected to do this. Notice has been given as long as probably 16 months ago that all of the vendors of these products had to get information out to their clients to warn of impending changes. They weren't defined, but they have now really been put to pen to paper in the budget. That'll have to be promulgated. So I think that the vendors are going to have to make some material changes. There are a few funds that we believe are compliant as genuine prefs, but where the dividend income comes in, there's going to be change, and that change looks like it could have impact on investors, and the investors must really get clarity and make up their own minds in the short term.
And this is really because in the past dividends weren't taxed while interest was taxed, and people were trying to get away with paying no tax.
Well, quite right. I think that dividends remain a very effective form of income for a high tax-paying individual, trust or corporate. The corporates have had that STC credit, which is changing to a dividend withholding tax, but there's still, if a pref share company issued a dividend, it pays the STC, and therefore the dividend carries a credit with it. So it's effective for companies who do pay dividends. What is going to change is the essence of the part of the budget that referred to this said that we will simply deem that supposed dividend as income in the hands of the taxpayer and tax it accordingly. So trusts will pay 40% tax, and individuals will pay tax up to 40%, starting low. Corporates would pay at 28%.
Well, you've mentioned that investors should be doing their homework about their dividend schemes. What would the alternatives be for investors to those?
Yeah, well, high income funds that take positions in assets that are not immediate call are a natural place for people to try and extract a bit more yield, but that comes with a big caveat. That is that the pricing of those underlying investments, if interest rates do firm, would drop. So you need to be able to stay the journey. The other big and natural opportunity is high dividend paying shares or the primary preference shares issued by banks that also carry capital, a big warning sign that there's a capital risk element. You have to be able to stay the chase. You have to stay through the troughs and the volatility of market to ensure that your capital remains intact, and it ought to over time, but that timeline can stretch for years in some instances. The third option is property income, and that's an area which is of great interest to us because that's a sector of the market that's done remarkably well and continues to be attractive, albeit also with a close correlation to bond markets. So where bond rates move up, either through issuance or through general interest rate trend, or a fairly material risk of higher inflation going forward, property funds would perform similarly. And there's an inverse correlation. So the higher interest rates are, the lower the bond price. So you want to buy when high interest rates are high. You do not really want to buy when interest rates are at a low. Earnings going forward for the next year, probably in the high single-digit returns can be expected. But the price of the underlying property funds have had a good run. And this year to date, they've been down as much as 10%. They're down about 8% at the moment.
Are distributions this year likely to grow faster than inflation in your view, Mike?
I think so, because I think the funds, the better funds, are well positioned. They're well located. They've got great quality tenants in them, in their leases. And leases have an inflation-linked escalation. So I think that they will outdo inflation as long as they can keep the cost side low and keep people in business in their centres. That should be fine.
Quick word on the rand. We've seen some rand strength coming through. Another opportunity to take money offshore in your view?
Yeah, Stephen, this is such an interesting debate. The rand has been to 11.70 in the last 3 years. It's down again at the sort of 7 and just below 7 level. That augurs an opportunity for people to diversify. It's not about betting the farm and taking all one's assets overseas. It's about using this as a clever diversification opportunity.